Yes, a very good evening, everyone. Welcome to yet another session where we delve into ICT, courtesy of TBS. We go through some educational content about how to use ICT concepts to delve into the financial markets. Welcome to also, welcome back in particular from the fundament of yesterday. It has been something we've all been waiting for, contemplating on whether we'll have the rate cuts or rate increase. So rate pause also in particular. So yesterday we were surprised, and to those who were sure that's also good, but to many of us who were surprised with 50 basic point rate cut at once. At least we expected 25. Then they hit another 25 to make 50, but they made 50 at once, and that is a clear sign of their strong confidence on inflation decreasing in the US. So whenever they start cutting rates like that, it kind of weakens the dollar, right? So that's why we see most of the pairs that are pegged with the dollar are going to strengthen against it. Then the dollar will have to weaken. So Euro USD is on buys, GBP USD is on buys. So all this is an attribute of the rate cut that happened yesterday. Okay, so today we'll be looking into how to verify the most important PD arrays of ICT, and that is what frames the core of ICT. So for you to really trade these PD arrays rightfully, you need to understand their validity. You can see a PD array, but then is it the right one to take a trade from, or it is just one of the manipulations in the market that most traders will fall for? So if you have the fair value gap, is it the valid fair value gap? If you have the order block, is it the valid order block? So we have to look into that today and see how to choose the right ones and where we choose them from. So the most popular PD arrays that we know, and we have to just keep your trading as simple as possible. You don't have to complicate it so much. Time will come when you'll focus on a few PD arrays that you best understand. You'll have to focus on a few PD arrays that you best understand. Go deeper into understanding when they work, when they fail, how best they work. That will help elevate your chances of profitability. So we'll look at majorly 3 PD arrays today. That's the fair value gap, the order block, and then the breaker block. But then I'll focus on the fair value gap and the order block because they are literally the most important PD arrays in ICT. The order block is simply the whole chart that you see. If you go deeper into understanding, ICT, realize that the whole of your daily chart, the whole of your monthly chart, the whole of your hourly chart is simply one single order block. So it is not order block that we derive all these PD arrays from. So I will start by challenging you into looking into this. One, the validity of a PD array, and then two, the area of interest. So what do we consider to see that this PD array is valid? So validity is what considers that this order block I'm seeing is valid, this order block is valid, this order block is valid, this FVG is valid, this FVG is valid or invalid. See that? So validity comes down to one of the things that we're going to ask ourselves: POI is the particular PD array at a point of interest. That's the first question you're going to ask yourself. Is that FVG that you're looking at a point of interest? Is that order block you're looking at a point of interest, right? Then you're going to look at another core item, and that is the higher time frame Okay, so when you look at these two things, they give us a clue on whether the PD array we have chosen is going to be more acceptable than the other that is existing at that very particular place. So the point of interest is simply liquidity and this can also be at a higher time frame. Normally we prefer the points of interest to be at like higher time frame zones. Okay, then we'll really have a more confirmation with that. For example, I want to see that an order block, the tools for drawing this. Let's use this. So if this is an order block, I want to make sure that this order block is sitting on a higher time frame zone than this order block. If we're talking about now the entries and all that. So we're going to go deeper into that slowly. You don't have to get confused yet. So this is, say, an order block. So we want to see that this order block is sitting at a point of interest. So this is going to be black. So this order block should sit at a higher time frame point of interest. So this in particular is going to be the hourly chart. It's the 1H or B. So this order block should sit on a higher time frame zone. See that? To confirm that this order block is going to hold price. Reason being, this order block is what we're going to be using to frame our trade or to hold the bias that we want. See that? One price to use this order block, right? That means this order block should sit on a stronger zone than the current time frame that this order block is appearing in. So if this is a 1 hourly chart, we want this order block to react on a daily zone. So to those who use time frame alignment, that is very key. You prefer to go from the 1 day to the 1 hour to the 5 minute. And to those who have been following us through this episode, you realize I don't use the 5 minute, I stop on the 1 hour. But then it's also okay to go to the 5 minute because it will help you refine your trades. Though I don't really like to go down there, but it's okay for you if you want to do it. So this is the 1 hour order block. This is the daily point of interest. So you find that you prefer an order block sitting on, say, this is a daily point of interest. So you realize that this particular candle is going to these templates. Okay, let's just leave with that. So you realize that this particular candle is sitting on a zone, but price has been dropping down for quite some time. It's dropping down. On dropping down, it finally hits this zone. You imagine this line a series of candles dropping. Then this particular candle finally hits this zone and then displaces the upside and closes like this. Or this particular candle dropped and then we now want to see a new candle pop from up here and then display. So this brings us to the next key interest that we want to look at. We say that once price reacts at a point of interest, we need to see a displacement. So what is this in a lower time frame? It's a market structure shift. We're going to look at how really price is built out so that you can be able to trade the right shifts and the right order blocks. So if this is an order block and then now this is the displacement candle, we want it to close above. So make this blue. We want it to close above this particular candle to confirm that this is an order block. So you realize that this high must be closed by this candle body. Someone may be asking me that what if we want to see series of small candles, because most of the times you realize that if you're using, for example, SMC concepts or even any other concept, the way people look at the market structure shift is a little different from this, but it's the same thing on a lower time frame. There is a tool I need here. Yeah. So when price is dropping, it's dropping down, dropping down, dropping down, dropping down. Then finally it hits a strong zone. When it hits a strong zone, it finally creates this big candle you're seeing here. And this big candle displaces and closes up, right? Then if you're using this particular mode of looking at market structure shift, you realize that price does this, makes this leg. We want it to hit a higher time frame zone like this, then shift. And by shifting, we want it to close above this high that created this low. Then we confirm that this is a market structure shift. Okay? We confirm this is a market structure shift. And then we want price to return back to discount of this particular range or this particular open here. Usually the open always works the most. So this high will be literally this particular candle high within what's open here. So price should return back here, then we begin a smooth uptrend to the upside. So how will this look like here? It looks like this. Now this is the order block that you're looking for. Price hits the strong zone. Then on hitting the strong zone, we need an up close candle to come and close above this candle high. When price closes above this candle high, this is a confirmed market structure shift. This same replica is what is happening here. The difference between this and this is a lower time frame than the 1 hour. So it has smaller candles dropping, smaller candles dropping, smaller candles rising, smaller candles rising. For you to confirm this, you prefer to see a close here. Now, if you're using the 5-minute chart, the 5-minute chart will give you a lower shift down here, but the issue is it can be false. For as long as we don't have complete time frame alignment, price can easily reverse off the 5-minute if the 1 hour has not yet completed the shift. Yes, many times you realize that they will say that you will be left out or FOMO or follow that stuff, but you prefer to take quality trades and a confirmed PDRAs. So the hourly chart hits a strong zone. This particular candle, you don't need to look at the highs, the lows. This particular candle, we need another candle to close above the high. After closing above the high, then we can now target what? The open. So the next verification is after closing above the open, so the high, we need now price to retest this open so that we can now push to the upside. So this is a green candle, but then if you're using this chart of mine here, it's a black candle. Then if I'm to change this, I'll make it green. So this is the green up close candle, this is the black down close candle. So this is the order block hitting the strong zone. We'll look at examples. Then we want to see price come from up here, tap on this zone, then buy to the upside. So let's look at that when it comes to a real candle. So the candle opens from up here and then drops to the downside. On dropping to the downside, it's black, right? It's black in color, like this. So on dropping to the downside, it's coming to react to the open. That's what you want. Now, if you're looking at this side, it is up here, this up part here. It drops down to the open. This is this particular in a higher time frame. So price now wants to react off from here. So you want to see price displace above and turn green. And then this particular candle leaves a wick from this reaction, and then this one becomes green. So you see how this is created. Then this is this reaction pushing to the upside. So if you're drawing it using a line chart or a lower time frame, the entry for this particular trade would be here. So we have to combine other things also. For example, the kill zones. We'll look into that. So price, we enter from here and then push to the upside. Same thing, that particular zone, this reaction here is this particular reaction on this order block. So you see the reason as why I don't need to go to the 5-minute chart, because I can look at that same structure on a 1 hour. So this very same structure is the same structure on this can be a 5-minute chart. Okay. So for the sake of a 5-minute chart, when price reacts here, you'll wait for a second shift that is happening within this zone. Or for high risk trades, people will take them from down and react on a higher time frame zone, wait for a 5-minute shift, then just take the trade. But then the issue is you don't want to be taken out most times. You want to prefer to take quality trades. And that means you have to go through time frame alignment for the daily chart to the 1 hour market structure shift, then you refine the 5-minute chart. Okay, so let's take a look at how this order block theory works. Now, the order block will appear in two ways. One single will happen, and then simply price will displace the upside after reacting on a strong zone. Then we retrace back, be it a 5-minute chart or 1 hour chart, then we push to the upside. However, there are times when price is not going to give you only one order block like this. Okay, price is going to give you series of order blocks. For example, what you see here. But then you want to see how you would trade this. So let me try to give an example of when we have only one particular order block to use to buy price to the upside or to the downside, because the reverse is true for any. What we are trying to look at, most of these are like fair value gap trades. Here we had an explosive move from down here. So this order block here was displaced, but price did not return back to the open. Price was running very fast to this order block side to push back discount. It used highs and used the fair value gap. So this was a fair value gap trade. So this displacement down, this is not an example. Then this is also not a single. Realize that this is a black candle that displaced below this, right? So the reverse is true for in case it's a sell trade. This is the last green candle in this uptrend, this correction move. Then price closed below this. So the interest is we want price to come back and then react on the open. So price didn't come back on the first day, it came on the second day, reacted, then rejected and sold. So this scenario is different from this one. This is a scenario where we have like 2 days to go up here, but it's similar. So I want to give an example of those so that we can look at all scenarios in case they happen on the chart. Same thing here. This is the last green candle displaced, but price used the fair value gap. Okay. So we have this one also, but then price used series. So most of them are series. This is a fair value gap entry. So liquidity entry, fair value gap entry, fair value gap entry, order block but series. Price not retrace back, came back as a series. Okay, let's first look into the three so that we can identify them easily. So this is the first. Price comes and taps a higher time frame zone, then immediately displaces and closes above this candle, retest and then buy. However, the scenario whereby we find there is this particular scenario. This is the higher time frame zone, higher time frame PD array. Okay, this can be a daily zone, and then price begins to move to the downside. So price is dropping. Imagine these are daily candles dropping, or the 1 hour candles dropping. Then they hit the daily zone. On hitting the daily zone, I want to transfer this into an order block because The order block is the last bullish candle or bearish candle that mitigates a strong zone and then reverses, right? Or it's the last bearish candle before a reversal. That's the most popular word in books. So if I can draw that order block the same way, and then we look at it in the charts here. So price comes, then this is the green candle. It's a black one, in fact, since it's a bearish candle. So this is a black candle, and then price mitigates it. So on mitigating it, what is our next criteria? We want price to do what? We want price to displace. This candle here is a down candle. For this order block to be valid, we need to close above to confirm a market structure shift on a lower time frame. Okay, so you keep that same image in your head. As simple as that, just to keep your trade very simple. Hit a strong zone, confirm with that. If that doesn't happen, just know it means there is something. It means price is still willing to go lower. But if price hits a strong zone, then immediately we have a displacement above. It shows a market structure shift. So this will look something like this on a lower time frame. Then this candle went up. We started dropping down on this candle. Then we hit this zone. Then we started shifting to the upside. Then we closed. So this move is how this candle looks like in a lower time frame. So 5-minute chart traders will enter from here before this candle is closed, and we don't want to always do that. We want price to engage and then accept that price is pushing to the upside. So we want to displace this candle higher. Now keep in mind that this particular example, price immediately displaced and closed above on the 1-hour candle. However, there's a scenario whereby price does not immediately go up. It will first try to play around within that same range. So what happens is price after reacting on the strong zone rises up, okay, but then does not close above this high. This is a sign that price has not yet shifted. It means that price is still playing within the strong zone and you're not sure of the market structure shift. Pay attention to these details. When price reacts on a strong zone, you want a displacement above the candle that reacted on a strong zone. And this candle must be a bearish candle to confirm it as a bearish order block. But if price reacts here and then price keeps playing around a strong zone, it shows that price hasn't yet chosen a side to go. And you don't want to engage on that, or else you find yourself in a time of distortion. So the market structure shift order, now this is a CISD, same thing of course. CISD is market structure shift. But then CISD is whereby you use PDR rates for the market structure. You don't, for the market structure shift, you don't use the highs and lows that we are basically told to use when it comes to basic price action. So you want this candle to close above this candle, as simple as that. That is very simple logic. So this candle fails to close above. We want the next candle, you wait for the next candle to continue pushing higher. This particular candle probably chooses to close above. When it closes above, this is very good. This candle does not close, this candle finally closes above. This is very good. So what will you be looking for? A retest of the open of this candle, as simple as that. This is a 1-hour chart. When price reacts here, you can go to your 5-minute to look for continuation up. But then if you are a trader like me, I prefer to take my entries on the 1-hour like this from here. Because sometimes you find the 5-minute gives a smaller stop loss, but then the retracement back here can be deeper. And I don't always like the lower time frame. But then same thing, it's also okay. So price pushes the upside, but then let's take an example. Price does not close above this place, closes and just leaves a wick behind. So price just gives in a wick, or even wicks like this. Let's just make it like this. Price wicks like this and fails to close above this candle high. This is not a market structure shift. This is a false one. This can act as a sweep, and we see when price sweeps liquidity, it can end up reversing back down. See that? So you don't want to participate on those kind of situations that price tends to hit a strong zone, gives a shift like this, then finally drops back down and takes you out. You want a situation whereby price has closed above with a body. When it closes with a body like this, now that means the structure shift is done. And that means now finally you can expect that price will retrace back and then sit on this zone to buy. Or if it decides to dip, it will dip and just enter and stop on this fair value gap. That is how the algorithm is created. It will do the same thing. So it will just retrace back probably into this fair value gap, then continue higher. So it will look something like this. It will look something like this. Price came from up here, reacted on the open. So our first area of interest is going to be the open of the order block. This, you don't remove your eye from this particular candle because this is the candle that engaged the higher time frame zone. We want it to be displaced above. So final price closes above this particular candle high, then our interest is price should react on the open. So this is the open of the order block. The reason as why we choose the open of the order block is because of when you study AMD, you realize that the opening price always has floating orders of the previous candles, be it a daily chart, a monthly chart, a yearly chart. The opening price has floating orders. Same thing with the closing price, but the opening price is always very sensitive for price to push higher or lower. So since price has floating orders here, when it is to make a retracement, that is a false move, because a retracement is a false move. It is an inducement move that makes people think price is reversing it is just making a small change. So price comes back to the open is where this is where you take your entries from, this open here. Then you expect price to push higher. So you want to put your entry from here. If it fails to dip, it will dip inside the fair value gap. But your entry should be here. Reason being, you're not sure how deep it will go. You want to start taking your trades early from here, from the open. Sometimes you can choose to use the open, or sometimes you can choose to use the FVG. So you want to choose to make sure you're in the trade as early as possible. So the open is the sweet spot. So this is where you want to put your trade from here, and then you expect price to push to the upside. So this is precision. You're trading with precision. I'm not using my laptop here, but if I was using mine, I would show you some templates that I have. I normally save those templates for journaling at the end of every week when I take the trades. So this price retraces. So if I can now show you using a candle, price will move from up here and hit here, hit the zone, and then push to the upside. Or you can push with series of candles. So this is now pushes, leaving behind a wick from the zone here. So that is why you would have taken your entry from. So these are the two types of order blocks. This order block that hits a strong zone, then immediately displaces the upside, and then gives us an entry is good. Then we have a situation whereby price has series of candles coming up from a strong zone, then finally retraces, then we buy. All the things you combine them with kill zone. But this is the best way to take order block trades because you're trading using a higher time frame first and foremost, and with a complete solid shift in place. Okay, so this series. Now another thing that you should put in mind is that it's going to be the last one now to make it more precise and clean. I hope you pay attention to these. So the next one is a situation whereby this order block you're seeing here that hit the strong zone has multiple candles here. Okay, these candles that close, that push to the upside, this is where institutions are present. Institutions don't make the fake move to the strong zones. Institutions move away from the strong zones. Institutions move away from liquidity points. They don't come to sweep your stop losses. No, stop losses are engineered to manipulate traders. Sorry, liquidity lows and highs are engineered to manipulate traders. So institutions trade away from liquidity. That's what they say. Prefer to enter your trades when price has swept liquidity, because institutions are not present during the sweep. They are present after the sweep. That's where volume comes in. That's where speed begins. When they sweep liquidity, then speed begins pushing to the upside. So this brings us back to the same thing here. An order block is here, right? So this particular black candle this time round is a series of candles that is dropping. This will be the last example so that you don't get knowledge paralysis. When there's a lot of content, it's also ends up confusing you. But then let's focus on this. Then you build on that. So this is a black candle in particular, because these are bearish candles. It is coming down to hit a strong zone. So it finally engages with a strong zone. Let me give it this. And then on engaging with a strong zone, what does it do? It closes. So on engaging with a strong zone, it brings us back to this concept. After price has hit a higher time frame PD array, we want to see a market structure shift that is in form of a displacement to the upside. Higher time frame zone. That can be like a higher time frame order block, a higher time frame fair value gap, a higher time frame liquidity sweep, any of that. So this can be a daily order block that the 1 hour candle came and dropped into. So I hope you know this, that a 1 hour candle is coming to drop in a zone. And if you are a scalper, then these are like 5-minute candles dropping to a 1 hour zone. So you put that in your mind. So price is coming to hit a daily zone for me as an intraday trader. So these are 1 hour candles dropping to hit that zone. I've already marked it. What do I want to see next? For me to confirm that this zone will hold price and price won't drop lower, I am going to need price to displace above this candle or this candle. Now, how far this candle is going to displace and close is not at our control. It can use series like this, small candles rising, or it can use a momentum strong candle like this. Our interest is which candle here is going to be closed above. Will they close above this candle or will they close above this candle? Let's take an example. When price pushes from here and then it closes above this candle, what did we say? Since it closed above the high, make sure it's closing above the high, not just the open, with a body, not with a wick. This body. Then what do? We enter our trades in the kill zone at the open. At the open. Retrace here and then push us to the upside. Retrace here and then push us to the upside. And then push us to the upside. Okay, but then this is the normal one, right? This first one, a price displaces with a very strong momentum and then it's able to close above this candle. So we want to take an example, or the last example, whereby price is going to displace above like 2 to 3 candles. Still, what would you do? Because someone would ask that. This price chooses not to displace here. It comes until the second candle. Now we have 2 black candles in line. Now it takes us back to the logic that we always say. What is an order block? An order block is the last bearish or bullish candle before a change in trend, or they will always make it is the last bearish or bullish candle before a change in trend, or it's the last series of bearish or bullish candles before a change in trend. You've seen that also. It can be a series of candles, it can be one single candle. So a series of candles means that in a higher time frame, this is just one single candle. If you understand that logic. Combination of 5-minute candles that are dropping, then price displaces above all the 5. It means that those 5-minute candles are a 1 hour order block. Let's not go into that confusion. So price pushes and then displaces above this. If it displaces above this, remember, and closes, and when the kill zone, enter from the open of this one. If it displaces still and then chooses to close above this particular candle, what do? We transfer liquidity to the next candle. So what you do is simple as you enter the trade on this second candle, taking this to be the market structure shift. So your interest is going to be, let price come and retrace back to this particular candle and then I push to the upside. You won't want price to come back down here because it won't come back. Why? Because this is one single candle. This is one bulk of a single candle. It's just having a series sort of move. So from here until here is one single candle. Okay? So since it's one single candle, you realize that you want price to close above this and then you enter from this one here. So price begins to push to the upside from here. Push to the upside from this side, and then this becomes the wick. Uh, a minute about that. So this becomes the wick. So the entry for the trade is going to be from here. It's going to be from this particular zone. Your stop loss is averagely going to be within this zone. You can see your stop loss should be between these order blocks here. Can be the low of the order block or mean threshold. So you want to make sure your stop loss is at least reasonably within this particular order block. Because if price goes below this order block, it means that it's not valid anymore. So price reacts here, and then that's when the trades push. So this particular push to the upside may not be mid like this, but it will be series of them. On a lower time frame, you'll find many small candles ranging up to the upside. So this series, reason being, we closed and this placed above this. But if this particular candle closes above this, we use this. So this is the most common one. Price will just displace above with series, then push higher, or the strong push to the upside. So what is the example here of what we are doing here? The example of this is this. This, if you see this, this is a daily chart. These candles came retracing down, and when retracing down, it reacted on an order block. Yeah, sorry about that again. So price finally comes and then reacts on this particular order block you're seeing here. This order block wasn't mitigated through this move up here. So price finally comes and reacts here. When it reacts up here, now we change our eyes to what we said. When price reacts on an order block and wants to give a new trend, we want to see the candle that is going to close above the order block and you use it as support. You get that? So this particular order block, this is an order block. It's the last black candle that hit the strong zone. Here we're looking at the daily chart before we go to the 1 hour chart entry. Price reacts on this particular daily order block. This is a 1-day order block. Taking the trade, I would use another concept. Right now we're talking about specifically those who use order blocks and liquidity. So here we see prices coming from a fair value gap, and that is an added confirmation that this order block is very strong. Price is coming from a fair value gap. So this is a fair value gap. It's a very strong zone. This order block here is a rejection block. Why? It is sitting on an order block. Those are not rejection blocks. Rejection blocks are order blocks that are sitting on another order block. So this particular order block here is sitting on this particular order block. from the open, came and then reacted from this particular open here, reacted on the order block, pushed to the upside. So this is a rejection block. Sorry, this is a propulsion block. This is an order block. So when price retested on the order block, it became a propulsion block, and this was later not mitigated. Remember, our interest was once price closes above this order block here, we want the next candle to come back and retest it, but it just pops up. Later in the future, it comes and uses it because there is still liquidity in it. So price does all this, then comes and mitigates it. When it mitigates it, using other trading schematics that we won't talk about today, we were talking about PDRAs, it pushes the upside. So we want to now talk about the new order block here. How would we confirm? Now remember, we said when this candle comes and reacts on a strong zone, we want the next candle to close above this candle. So this is the candle. So this candle pushes and closes above. On pushing and closing above, when you go into looking into other things, you realize this is a consolidation in a lower time frame. So from a consolidation, we don't reverse, we expand. So let's talk about specifically how we use this order block. So price pushes the upside. It does not use any of this order block, but you will mark this. After pushing to the upside, it does not retrace the next day into these order blocks. It leaves what? A fair value gap. And also here having a fair value gap. It means that price is extremely strong to the upside, but it doesn't mean that order blocks are going to lose their use with time. You keep looking at that, but using other schematics or looking now at other pairs. So price pushes the upside, does not come back to these order blocks. It shows strength because we have from a consolidation in a lower time frame. Then price consolidates again here, then pushes the upside. Now you're transferring your order blocks up and up because we said our interest is which candle closes above which one before we trace. So when this one closes above these two candles, what we want is price to react on this open, but it does not come back. It's not us to control that. We mark this fair value gap. We want price to come back, price mitigates, then it pushes the upside. When it pushes the upside, it closes above this candle, and this candle. This takes us back to which type of order block? It takes us back to this type of order block. This kind of order block, we have many candles on the left, then price displaces and we have to react on the one which closes above which one. So on this particular order block, price displaces up and closes above this one and this one. So you want it to come back and react here. But also bear in mind we have a fair value gap here. Fair value gap here, so this could be a fast shock, but price does not come back here. Price pushes the upside and finally it closes up here. When it closes up here, the most recent candle on the left which we closed above is this one, not this one, because this one's high is way up here. So this is the most recent candle we closed above. So if you were to mark the open of this candle, you realize that the open of this candle is this. So when price closes above, our interest is price should come and then react on this order block. It won't come back down here. Reason being, it has already had this strong close above. The candle which is considered to be the one to be used to push price higher is the candle that they close above the high. So when price continues closing above highs, you continue shifting your order blocks. So price shifts and then pushes upside. This becomes the most recent. Now that's where we got our trade yesterday on. So this trade was news. That's now the difference with this. It's not going to be as clear to you as maybe you'd want to see, but this was news. So you see news also respects structure. So when price rose up here, took this high, we sold. On selling, the next day, price made an FVG sort of weak, pushed to the upside, rejected. Then today, price drops. On dropping, it mitigates on the order block. So let's go into the 1 hour chart and see how price would react on this particular order block. So this is the 1 hour chart. So now it takes us back to the concept of what we spoke about. We said that if this is the higher time frame zone, we want it to be where there's going to be a shock, right? We want price to hit that higher time frame zone. When price hits that higher time frame zone, we bring in the concept of we want to take our entries in the kill zone. So if we want to take our entries in the kill zone, let's get back onto how we trade this. So today, Asia opens at 17. I'm not using the tool, but my PC would give all those demarcations. Now I have this. So Asian session is this session here. It opens from 17 up to midnight. So at midnight we are all sleeping. I'm using New York time, by the way. This is -4 UTC. So 17 is midnight in Uganda. Then midnight of New York is 7 a.m. in the 7? Yeah, it's 7 a.m. in the morning, Ugandan time. So but me I use New York time. So we hit this higher time frame zone in Asia, of which at this time you're not trading. So straight away, when you're doing analysis, you can start looking at what's going on. So price displaces. When price reacts on a strong zone, all our interest is checking the order block that is existing. This is the order block. So price displaces, not above this. Displaces, not above this. Now finally it displaces and closes above this order block. But when it displaces and closes above, it is not in the kill zone. It reacts on this weak small part of the order block at midnight sharp, right? So this is not where we take our trades from. We want to take our trades at London session. So what happens? Price finally, it clocks 2, which is 9 a.m. in Uganda. And this is when you want to start looking for our entries. But you realize that your interest is price should react on these order blocks. So you would have already marked your order block zone. If I can put this, this is one of the simplest ways to trade because you don't need a lot of noise when it comes to a lot of data. You just focus on hit a strong zone, give me the order block shift, and then I go to the kill zone for precision. This. So this is the order block. So we want price to come and then react here, but then it does not come back in. It does not come back in what in London session. It continues pushing to the upside. We don't chase the market. We want the markets to come to us. So what happens? Finally, price at 8 UTC time. At 8 UTC time, that is at 3:30. That is 3 Ugandan time. Price finally comes back down. Then it mitigates in New York session. So this is London session. Price is pushing to the upside. If you use the indicator, price is pushing to the upside. The London session stops at 5. So at 5, price now we'll talk about something to do with news trading. The reason why this price dropped like this is because of something to do with news. When we sweep any liquidity, we trade away from news, away from that liquidity zone during news. That is a concept maybe we'll talk about next time. So price finally retraces back to the order block which hit the strong zone. Our interest is to trade the volume of the day. Okay, so price hits the higher time frame zone. On hitting the higher time frame zone, we start shifting. We finally close above the order blocks, these black candles. When we close above them, outside the kill zone. So we don't enter. In the kill zone, we want price to retrace back into this 1 hour order block zone for us to take our entries precisely. 1 hour OB. But then what happens? It does not retrace back. It continues pushing to the upside. So we don't take any trades in London, wait for New York. Now, most especially if we don't take the high of the previous day, all that logic comes into place. When you don't take this high, see, we don't take this high, it still confirms that price is not yet willing to go short because it needs to take this high from internal to external. So when you hit this zone, we're targeting another liquidity zone. So this is buy side liquidity. Buy side. So this is buy side liquidity. So buy side liquidity is going to be your target for the day. So price makes this push, does not retrace back in London, finally comes back and hits the zone in New York. So New York opens at 8, then this is the New York zone that price has reacted. So price comes and hits this zone, you got to put your order block here. So this is like price retraces back to the order block zone, and then this is where your entry is going to be, as simple as that. as simple and precise as that. So you're risking about 15 pips or 10 pips. I usually put 10 pips on Euro USD. So about 10 pips, 10 to 15 pips for you to get at least 1 to 5. So if you put these highs, it's good. Then there's also this buy side liquidity for your trade. But then we are almost closing that day. So this is already 1 to 1, 2, 3. It's already 1 to 4. That is already in the trade. So all you're doing is you're looking at from hitting a higher time frame zone. After hitting a higher time frame zone, which is probably a daily zone, our interest next is what? After hitting a daily zone, we go to the 1 hour chart. So after hitting the daily zone, what's wrong with this? Yeah, after hitting the daily zone, we want to go to the 1 hour chart. So the daily zone is simply a support or resistance zone, what we call S and R. These are true support and resistance zones in the sense that they hold price or resist price. So this is a strong zone, right? So this is a strong S and R zone. It can be a higher time frame order block, a higher time FVG. Then after hitting that strong zone, you run straight to the 1 hour chart, and all you're waiting for is that candle that came and hit my zone. Where is it? So if this is the candle that hit that order block zone, that higher time frame zone, I want a displacement above that high. When that displacement is happening, which type of displacement is it? This single, or is it going to be this whereby there are a series of candles running up, like today's trade? So today's trade, we hit the higher time frame zone at Asian session. Very simple schematic. We hit the higher time frame zone at Asian session. So we close, this is the higher time frame zone order block. We hit it in Asia. You're sleeping, you don't want to take the trade, you don't need to worry about that. So price begins to push up, finally closes above its order block. It's the last bearish candle, yes, but then it's not in the kill zone, so you don't take it. Continue pushing. Finally, we reach the kill zone. Which candle is the most recently closed? It is this one, right? It is the last bearish candle. If we closed above this one, we would consider this one, but we are still here when the kill zone opens. So this would be your interest. So price begins to push to the upside. When it begins to push to the upside, I will trade this going down because I'll be trading news. Today is a Thursday. So and we know every Thursday we always have unemployment claim news. So that news is always traded every Thursday. And most times it's good for the dollar, if you notice that very well. Unemployment claims is usually the number of people who are registering for unemployment insurance in the US. So most times the US is performing well recently. So it strengthens the dollar. So it dropped it back to our order block, and boom, from here, just take your trade higher. Those who want to look for 5-minute entries, still you can do the same thing, but you can do the same thing. You come here. So what you'll be doing is now you'll be considering the 1 hour as your higher time frame. So you're looking for a second shift inside here. And the second shift that is going to happen is this is the candle that dropped and hit. So you want price to close above and also a fair value gap. So price pushes and closes above here. Then the entry is in this fair value gap here. So price keeps on playing inside your stop loss until it delivers up. Then it pushes up here. So these are the trades that most people prefer to see when there are many small candles. Yeah, it's also good. So that is how you would trade when it comes to the order block entry. It is as simple as that. Very easy peasy schematic. So if I'm to look at USD JPY, I think I'll just look at it. USD JPY is also giving us something to do with the previous yesterday. These were sure buys today. You can see from this order block. You can go to the daily chart. These were sure. Use another broker. Euro USD JPY. These were sure buys. Same logic. What did we say? This is the last. These are the series of down close candles, right? We start looking from the first. When price closes and sweeps, for example, liquidity up here, we want this next candle to close above this high. When it closes above this high, we use this one is open.